These people are running social experiments on the money that everybody uses to see how much they can screw everything up. And he says, quote unquote, we could really get into trouble if we commit. You in your ivory tower in the Mariner Eccles building, who gets a salary and can be paid in any currency and take a flight to anywhere in the world and be on top of the world in your elite little bubble. You say we could really get into trouble? What of all the people that you raped their money and destroyed their purchasing power? What the hell are they going to do when they don't have a job because of another lockdown? Hey guys, Rafi here from the Endgame Investor. You can find me on Seeking Alpha under the pen name AustroLib. A bit of a truth bomb from the Fed's Bullard today on Reuters. He actually said something that should be very disturbing for any Fed enthusiast who believes in this monetary fiat garbage fluff. Usually Bullard is full of bull, but this time he said something that was pretty shocking. Now, before I go into exactly what, I've been hammering the point away on these videos that at some point soon we are going to see a massive shift in mentality from monetary policy guessing to inflation leading prices higher everywhere, and the Fed chasing inflation and investors chasing inflation higher. That is going to be the pivot point to when this monetary system starts to spin out of control, and we're very close to that point. And when it comes, it's going to be very obvious to everybody exactly what is happening. That point back in the 1970s was January 1977. That's when monetary policy started tightening, but gold and consumer prices started climbing anyway. Here's the truth bomb from Bullard. Misreading inflation could require very disruptive rate hikes. Market Watch. So, very, very short article. All it says is, if the Federal Reserve misreads the strength of future inflation in order to delay tightening monetary policy now, it could require very disruptive and swift changes in policy down the road, St. Louis Federal Reserve President James Bullard said Wednesday. Isn't that honest? Not quite, but it does sort of get to a point that nobody wants to admit, and now they're starting to. Second paragraph, arguments in favor of a go slow approach to changing monetary policy are a playbook from the aftermath of the global financial crisis, less relevant to an economy with higher than expected inflation and likely fast job growth, Bullard said. We could really get into trouble if we commit to a delayed exit from low interest rates and the current $120 billion in monthly bond purchases, he said. First of all, I just want to say one thing about this that really pissed me off. These people are running social experiments on the money that everybody uses to see how much they can screw everything up. And he says, quote unquote, we could really get into trouble if we commit. You in your ivory tower in the Mariner Eccles building, who gets a salary and can be paid in any currency and take a flight to anywhere in the world and be on top of the world in your elite little bubble. You say we could really get into trouble? What of all the people that you raped their money and destroyed their purchasing power? What the hell are they going to do when they don't have a job because of another lockdown? We can get in trouble. What about them? Anyway, the other thing that pissed me off about this is he kind of understates it. I don't even know if he realizes it because he's Bullard. He's full of bull. But he says back in the first paragraph here, it could require very disruptive and swift changes. Very disruptive. Let me show you what very disruptive is. This is very disruptive, okay? This is 1970s, 1980. I told you that the pivot point in January 1977 was over here, right? Right around here. So that point in January 1977 is where the price inflation rate bottomed out and gold and everything else started going higher as the Fed had to chase inflation higher. That was destabilizing for everyone. But this is much, much worse. I mean, imagine how many bonds are stuffed in banks all over the world, how many treasuries. Be much more than destabilizing. I want to go into the actual interview that this Reuters article is quoting. This is from my subscription service, The Endgame Investor. Here I transcribed key parts of this interview. And we'll play a little piece of it just so you can get some tone. So Bullard says, he's the president of the St. Louis Fed. You really got a booming economy on many dimensions, and I think that's showing up partially in higher prices. Even core PCE inflation measured from a year ago is 3.5% here, well above the target of the committee, and I think it will remain above 2.5% in 2022. So you've got an inflationary shock here that is large, and that the committee has to take into account when trying to calibrate policy in 2022. Okay, so he's talking about PCE inflation. Core PCE inflation is the most heavily manipulated index that the Fed supposedly uses as its favorite one because it understates the problem. So then there's another question. If inflation comes in a little bit higher, would it be a real concern? So here Bullard says this. I think that there are risks around that. Inflation prediction models aren't that great. The risk would be that you have an even higher inflation than that, possibly much higher in 2022. And then in that situation, the committee would have to move into inflation fighting mode. And that's what I've been concerned about, is that we're out of position for that scenario. Talk about an understatement. In 2022, and if you had to raise rates rather quickly, that would be very disruptive for markets. No, it wouldn't be very disruptive. It was very disruptive back in the late 1970s. In this environment, it would be catastrophic, and it would be the end of the monetary system as we know it. That's what it would be, and that's what's coming. So he continues, I think it behooves us as policymakers and also markets that we get the taper finished in the first quarter of 2022, and then that will create optionality for the committee depending on how the data comes in. How is ending a taper going to create optionality for anything? You still got interest rates at zero. There is no optionality just by stopping to buy bonds. Anyway, then he says, if inflation moderates as many are expecting, we're in great shape for that scenario. Wonderful, great shape. I'm sure he goes to the monetary gym. Optionality. That's, let's say, like a big fat guy who eats $120 billion of junk food every month. He says, okay, I'm going to stop eating junk food. He's still fat. He's still got to exercise. He's still got to live a normal life. He's nowhere near that just by stopping to eat $120 billion of candy every month. Anyway, but if inflation doesn't moderate and stays at a high level or even goes higher, then we would have to switch into a monetary policy that would actually put downward pressure on inflation. That would be quite a ways from where we are now. So I've been trying to emphasize that we're out of position for that scenario. Now, interesting. Volcker had to go into this mode where the Fed chases inflation back in the late 1970s. That's why he was appointed. That's what he had to do, and that's what he did. And that's why the Fed funds rate went up to about 15% here in 1980, just around the time when gold was peaking. Volcker's strategy was to just let the Fed funds rate go where the market pushed it to. And that is where the market had to push it to. He didn't look for a target. That wasn't his policy. His policy was to get bank reserves down, and whatever happened to interest rates is what happened to them. He wasn't controlling them actively. That's how Volcker conquered inflation, by letting interest rates go where they may. Now, taking that into account, in that context, I'm going to read something from Bullard's interview that should scare you. He says, on the go slow approach, he was asked a question about going slow on rate hikes. He says, there's a clear risk here that we lay out a go slow, which is really a playbook from the aftermath of the global financial crisis, and we could really get in trouble. That's the line that really infuriated me from the Reuters piece. We could really get in trouble. We could really get in trouble if we commit too heavily to that kind of sequence. Because if we did have to move to put downward pressure on inflation, it would mean that the asset purchases would have to cease, and we'd have to raise the policy rate above the whatever you think the neutral policy rate is. See, that's where he's wrong. That's not what Volcker did. He didn't say, oh, I think the neutral policy rate is 15% on the effective federal funds rate. That would be crazy. He didn't say that. He said, I don't know what the hell the neutral policy rate is. I'm just going to shrink bank reserves until inflation is under control, and wherever the neutral policy is, the market will decide. It was 15% back in 1980. That's where the market decided to put rates. So where do you think they'd put them now with inflation the way it is, the amount of debt everywhere? I mean, if the Fed decided to pull a Volcker to do what he did, interest rates might have to go to 30, 40%. It's impossible to even know. Now this, I want you to hear. You need to hear this, okay? So I'm going to go to the interview and I'm going to play it because you need to hear the tone of his voice here.
And you think your forecast, you pencil in the first rate hike in the fourth quarter of next year?
Yeah, I'm still in the fourth quarter of 2022. I think that's, to me, that would be a logical place for liftoff. I think, again, the job market, that's a good 18 more months of very strong growth in the U.S. economy, robust improvement in jobs all through that period, and probably continued upward pressure on prices through that entire sequence. So it's very possible.
Continued upward pressure on prices through that entire sequence. And now listen to this guy.
Look at this fucking guy.
That we'd be to the end of 2022 and we'd be seeing more inflation than we care to admit.
You hear that chuckle at the end? Seeing more inflation than we care to admit, and he laughs. These people. Unbelievable. We're getting close to a point where the narrative is about to shift. It's getting close to where the Fed has to start chasing inflation, or where it admits that it can't, or whatever happens exactly, it's going to get out of control. Don't know exactly when, and there could be a major sell-off before that point. But if there is, for technical reasons, we have cash, we are ready, and the final plunge could be very close at hand. This is Rafi from the Endgame Investor. Please consider subscribing to the Endgame Investor for a 2-week free trial, so you see what I'm doing and how I'm protecting people during these crazy times where central bankers have gone mad. Have a good day.